Good afternoon, everyone. For those of you who have not met me, my name is Matt Santoro. I'm a senior tax associate on staff at Granite Peak Associates, and we'd just like to say thank you for taking some time out of your busy schedules to join us for today's webinar. I'd like to introduce you to Jeff Hiatt. Jeff is the Director of New Business Development at MSC. MSC is a consulting firm that has expertise in performing cost segregation studies on real estate property. And I'll let Jeff get into it, but these studies are a great tool to help business owners like yourselves generate a lot of tax savings. So, Jeff, I will give you the floor.
Thank you very much. I appreciate that, Matt, and the rest of your crew there, Jessica and Caitlin. Thanks for having me on today. This is, as Matt just said, a great tool to help people reduce their income taxes. And if you can reduce income taxes, that enables you to do other things with the money that otherwise would have been sent down to Washington, D.C. So with that said, I'm going to go ahead and pull up my my slide presentation just so we have it here, and we'll kind of go through everything. And I'm going to pull this over now. Fortunately, that went nicely there. Good. Oh, darn it. Okay, so here we go. So let's see. There we go. Okay, so that's the disclaimer, blah, blah, blah stuff, which I'm going to just skip over. So MSC or MS Consultants, we've got about 250 years of experience doing cost segregation studies. And I know that sounds like it makes us probably the coolest kids in the cafeteria here, but we've got about 20 engineer types and probably 10 CPA types that do the work with us. We've done about 24,000 studies since 1996. I joined the firm in 99 when it was just one CPA and one engineer. And since then, obviously, we've grown. We've got 6 offices throughout the country. Not only do we do cost segregation, which we'll get into, but we do other things that are things like energy efficiency studies to help take advantage of the tax code and where the tax code intersects with engineering and real estate. So where that intersection happens, that's the playground we're on. So we help people utilize the tax code and commercial property and residential rental property too, to take advantage of tax benefits that are available. We're proud members, and actually we're some of the founders of the ASCSP, which is the American Society of Cost Segregation Professionals. And that was started back in 2006 to kind of provide oversight and guidance to the cost seg folks out there. There are many folks, I'll say, in my space, in other words, competitors, that are not members, and they play a little more fast and loose with the rules and with the way they do work. So if you don't see that logo on somebody's information, that just be aware that it could be a challenge if audited. We've, as I said, done 24,000 studies, and we provide 3115s, which help you step back in time. So what we're going to talk about is, what is a cost seg study? It sounds like a really weird combination of words. What does it mean? So what it is, if I ask most people out there that are in business, if I say, hey, would you rather have a deduction today, or would you rather wait 39 years to get the deduction? Most people would say they would prefer to take the deduction sooner versus later. And that's exactly what a cost segregation study does. It enables you to take items that are eligible for a faster write-off, in other words, a faster deduction. You take them now versus 39 years from now. And so it relates to personal property and real estate property, or land improvements as well. We have this here to kind of show the difference and the power of the accelerated depreciation. And what I mean by that is, if you have $1 million in 39-year depreciation, you would get to write off basically 25 grand a year for the next 39 years. Okay, that's straight line. If you own an apartment building or a residential rental, instead of 25 grand per year, you write it off over 27 and a half years and you would get 36,000 a year. But if you can take that million and write it off over 15 years, the numbers are much higher. So 95 grand, 85 grand, 77. So you get a lot more up front. You get into 7-year property, if you can write it off over 7 years, which a lot of your veterinary practice assets will fall into. You see the way that the calculation works, it's much higher on the front end. And then 5 years as well. So the bottom line is you can write off that same million much more quickly. And again, when I ask the question, would you rather write it off over 39 years or take it sooner? This is what we're talking about. And that's why people get excited once they understand a little bit more about what cost segregation is. I'm going to use a number. I'm going to use a number in a building here just because it's a good graphic and it explains it quite nicely. So we have a client who has purchased a building for 7.5 mil. Really, probably the purchase price might have been 10 mil because you have to sub out land. So you sub out land, now you're in, and this was in 2017, and they've done straight line depreciation, everything over 39 years. So this is, in theory, the building. And so the way that it plays is this. For a 2017 acquisition, they paid the 7.5 mil, and they've taken so far $1,065,000. That's where they sit today under straight line. Now, the cost segregation comes in and says, wait a minute, we can identify a bunch of stuff that goes into faster lives. What does that look like? So what that means is we just found that the client can move 2% into, or 150 grand into 5-year life, 8% or 600 grand into 7-year life, 13% into, or 975K into 15-year life. So with that reallocation of 23%, they could have at this point taken 1.9 mil. So they've taken a mil, could have taken almost double that, which means they're going to get a $919,000 catch up in depreciation in the first year of completing this study, which is going to reduce their income tax by $367,000. Okay. Now you might say, well, Jeff, you know, they can't amend that far back. Well, the beauty is you don't have to amend. You can go back technically to 1986 if you wanted to grab the missed depreciation that you haven't yet taken. So you can do this even if you've owned the building for a number of years. Typically, the real window of opportunity is 10 to 12 years of ownership, and that's really when it's going to make the most sense. But you can go back farther if there was a reason to. Now, I'm pointing this out as an acquisition because from 1996, when cost seg came into play, from 96 to 17, so call that 20 years, cost seg never applied bonus to existing buildings. In other words, people were thrilled for those 20 years to just be able to reallocate into 5, 7, and 15 year and grab that depreciation over 5 years, 7 years, and 15 years. And then along came 2017 and what's called the Tax Cuts and Jobs Act. And so, well, oh, I forgot. There was one more little bubble I needed to mention. So the 367K grows to 399K by the 5th year after completion. So it gets better, okay? Now, here, and this is for 2017 construction where bonus comes into play. Bonus comes into play for new construction, okay? And what that means is we're still dealing with the client that's taken 7.5 mil. Oh, let me go back one. So if you remember from our prior slide, they had taken straight line $1,065,000, but with 50% bonus in play, instead of 1.9 mil, which was the prior number here, now they could have taken 2.2, which means they picked up another couple of $100,000 of depreciation, catch-up depreciation without amending. And now that number becomes 471 instead of that 399. Okay, so this was 2017 prior to TCJ, prior to Tax Cuts and Jobs Act. So this is a side-by-side comparison illustrating the power of bonus depreciation and how much better it makes it if you can use bonus. Okay, so now we're going to get into a 2024 acquisition or construction, because now we're talking about bonus coming into play on existing buildings and also in play for construction. So here we had the 7.5. If you did nothing else, you would get 104K of depreciation. But with bonus in play for 24, it's 60%, which means you get to take 60% of the items that we've identified. So 60% of this 23% of the building, which means instead of $100,000 of depreciation first year, you're getting 1.1 million first year depreciation deduction, which means the cost seg just handed you $1,076,000 of increased depreciation, and your first year tax benefit there is 430. And now by the fifth year, that 430 becomes 489. So it's bonus depreciation really helps turbocharge the effect of a cost segregation study. And by the way, you might be saying, oh, my building isn't worth, or we didn't pay 7.5 mil. Well, even if we just move the decimal point one spot and it becomes 750 grand, the numbers would be, you would get 10 grand, but now you're going to get 118,000 if we just move the decimal point one spot. And so this becomes a tax benefit there of 43,000, eventually growing to 48,000. So all things are relative and the concept still plays. It's just, what are your real numbers? So everybody asked me, okay, Jeff, that's all well and good, but I want as much as possible into the faster lives. What are, what's eligible for acceleration and what's not? So the IRS has identified the items that are eligible for acceleration and those that are not. And so basically what the IRS says is a building to be a building has to have certain things. It's got to have walls, windows, doors, roof, HVAC, plumbing for a bathroom, and electrical for lighting. So you got the foundation and the walls, you've got roofs and ceramics, so you see all of that fun stuff there. That's the 27.5 for apartment buildings and 39 years for anything else out there. So your veterinary practices are going to be 39-year. Then they make a distinction and they say, hey, basically from the property line, so imagine your own property, you're coming off of the public road, driving in, and as soon as you cross off of the public road and you get into your property line, everything that was put there as part of a plan can be in 15-year life up until you get to the side of the building. So basically anything from the side of the building out to the property line can be accelerated into 15-year life. They call it land improvements. So let's look at this picture. So you've got trees. So you can take trees, whether they're little baby trees or big trees, you get to call that 15-year life. Well, there's irrigation systems. How do we know that? That right there is an irrigation head. So you get to take that. Landscaping, which are going to be shrubs and planting beds and little retaining walls and things like that. Over here, we've got a wall, retaining wall, and you've got this big like park kind of setup. That's all going to be there. Well, look at this. This is a little bridge. Well, that little bridge, 15-year property. This signage, it's probably got electric in it too, because at night it probably lights up. That's going to be 15-year. And I mentioned the trees. And then you've got light poles. And then you've got wiring under the ground to supply those light poles, the power. And you've got conduit that has the wire in it and compacted gravel around the conduit. So basically, in the curbs and the sidewalks. So everything from the building itself out to the property line is going to get to be accelerated in a faster life. Now, somebody out there is probably going to ask the question if I don't bring it up, so I'll go ahead and bring it. If you've got a 10-acre parcel and you've used 2 acres of it, and behind you have 8 acres of a forest, you can't claim all those trees have a high value. You can do the trees that are part of a parking plan like this, but you can't claim a forest of trees and then individually get a dollar value on all those. But that was many times people ask that question. I always tell them that's a good try, but they don't allow that. Oh, also parking lot I mentioned here. And I think I've covered all the other items there. So now we're looking at, okay, inside, and this would be more like a veterinary practice here. So we've got decorative wood panels, wallpaper, wall coverings. You've got window treatments, whether that's on the glass or drapes or blinds of some sort. Specialty electric and plumbing. And you say, well, what's specialty electric? Well, any electric outlet that supports a device that you need, whether that device is some sort of X-ray machine or some sort of monitoring device or an electronic display system, anything that has a unit or an item plugged into it for day-to-day use would be specialty electric. And that goes into the faster life. Whereas a plug that's just down along the wall would not be specialty. It's just there per code. We've got carpet and removable tile. Let's see here. You would have accent lighting. So if you have sconces or pendant lights like this, which give obviously a nice flair to the place, you get to take not only the light itself, but that wiring up to the junction box and then back to the circuit breaker, and then from the circuit breaker to the transformer. So that's what our work breaks apart. You've got all of these nice cabinets here that would go into a faster life. Window treatments, again, I mentioned. You're going to have lots of wiring for all of these computers and the phone system. So these are the things when people ask, well, what's going to be eligible? That's what's typically eligible. Then we get into specialty HVAC. So you might have a situation where you want to control the humidity because of maybe it's where you keep the dogs and cats that you're caring for. Maybe you have specialty HVAC systems to control the humidity or the odor or anything like that. So you want to have, that would be specialty above what's needed just to keep the occupants warm or cool. Specialty water lines, like any medical practice, there's going to be specialty water lines, for the sinks and all. You're going to have some sort of electronics here. And all of those items are going to go into that faster depreciable life. So you can use this not only for new buildings under construction, that's easy. You can use it for existing buildings that you're renovating. So maybe the practice has been around 40, 50 years and you've just bought it. Well, in that case, if you're going to renovate, it would probably make sense to consider doing a cost seg on that because you bought it, even though it's 40 or 50 years old, but the depreciation clock reset for you at that time. So when it resets, that means it's as if it's brand new and you get to take depreciation on it, even though it's older. So you can then take that renovation cost as well and accelerate those items. And that's where you would be talking about maybe you've bought an existing property or maybe you're renovating an existing property. I mentioned earlier, you can technically go back to 87 when the tax law changed. They called it Tax Reform Act 86, and it changed in 87. An interesting thing, some of Granite Peak's clients are probably generational veterinarians. And so maybe you're thinking, well, you know, my father started the practice 50, 60 years ago, and we've been in the building ever since, and it's all good to go. We haven't bought anything really in the last 10, 20 years. So, Jeff, what are you talking about? Well, one thing again, where that depreciation clock resets is when generation one passes on a property to generation two, the depreciation clock resets. They call it a step up in basis. And if that's occurred for you, that means, again, it's as if you just got a brand new building and you get to write it off. And cost seg could help you save money there. This is more of a generic point here but it illustrates the point of what might you expect for a reallocation to look like or to be. So for hotels, office buildings, you're going to fall into the medical office space. So it might be 15% to 32%. And the logical person out there is going to say, well, Jeff, that's quite a spread. What's the diff? What's going on here? So this column, the left column, would represent basically an urban setting, like a downtown setting without much space, without much outside. So imagine downtown, any town in New England, or, you know, if you're elsewhere, downtown with, you know, basically a sidewalk, on-street parking, maybe not much off-street parking, no, you know, big expansive grass areas, basically just an urban setting, a downtown setting. That's going to be less because guess what? If you're in that urban setting, there's less land improvements versus the same exact building plopped down 15 miles out of town in a suburban setting. And now you're probably going to have more grass. And maybe you have little walking trails for the patients that need to burn a little energy before they come in. So you might have things outside of the building. And that's where you would get a higher reallocation then. And again, it plays through no matter what the food group we're talking about, whether it's hotels, office, medical office, shopping, anything, it all plays there. And that's how that gives you an expectation of what you might see. So there are reasons to do this or not do this. And typically, the folks at Granite Peak are very good at identifying when this makes sense or when it doesn't make sense. So if you're not making money, this probably doesn't make sense because you're going to have losses already. If you're not making a profit, you're probably not paying much income tax. But if you are paying income tax, in other words, you are profitable, then this probably does make sense. So the folks, Matt and the team there would be able to help you identify whether this is going to make sense or not. Another reason to do this or not do this would be looking at early disposition. Another way of saying that is if you're going to sell the property right after you bought it. Now, that's typically not going to come into play with this type of conversation with a very specific group of medical professionals, that you're not buying and flipping properties. But in the real estate world out there, there are folks who come in and buy a building, own it for a very short amount of time, they put some pretty paint on it, and then they sell it to the next entity, called buy and flip or early disposition. That's probably not going to play here, but if you only planned on owning this for a year or two, this probably doesn't make sense unless you love 1031s, and then it could make sense. Passive loss limitations. Now, again, with a lot of folks, passive losses mean that if you are not a real estate professional, and my bet is most of the folks on the call or most of the clients are not real estate professionals per se, the losses we create with a cost segregation study are called passive losses. And passive losses can offset passive income. In other words, either income from the rental of the current property we just cost segged, or other properties they own. Now, in your situation as veterinarians, more than likely, you not only own the operating business, but you probably also may own the real estate. And in that case, you can get treated as an active trade or business by using the grouping election. And that's something Matt and the team can talk to you about, is if you would in fact qualify for the grouping election, which is a beautiful thing, because then you get to use this not only against your passive income from the theoretical rental of the real estate by the operating company, but it could also offset some of your W-2 income or 1099 income, which is a good thing. Estate planning is another tool that can be used here. And what I mean by that is sometimes clients are thinking about, hey, should I go ahead and get this building outside of my estate? And that could make some sense from one facet of looking at whether to do some different types of estate planning. With real estate, one of the interesting points could be, again, with that step-up conversation we were talking about for inherited buildings, sometimes generation one, as part of the estate plan, may leave the real estate in their estate and do the cost seg. So generation one pulls out the value from their ownership, and they get to take advantage of that. And then in 3 years, 5 years, 10 years, when generation one passes on and the property goes over to generation two gets the step up, and there's no recapture or any other clawback of that depreciation. So that can be an interesting way, potentially, for generation one to fund some estate planning, life insurance, or some pension plans, or some other ways of coming up with money that they may not have otherwise had available because they were having to send so much to Washington, D.C. Intent to demolish. Okay, so if you buy a building and you're going to bulldoze it, so you bought an ugly building and you're ready to bulldoze it, the IRS calls that intent to demolish. And if you're going to intend to demolish it, you can't depreciate it. There is a workaround called a general asset account election, and you can make that. And in that case, there have to be a few hurdles you have to get over. And what that would mean is you would want to talk to Granite Peak and say, hey, we're buying this building. We're thinking about bulldozing it. What are the implications? And the bottom line is, as long as you make that declaration that it's going to be a general asset account election in the first year of ownership, number one. Number two, it has to collect some kind of rent, so it has to be in service for that first tax year. As long as those thresholds are met, you can go ahead and continue to depreciate that building even though you've bulldozed it. Again, that's under the GAA election, and it needs to be made the first year on the 4562. If you don't check that box, then it's out of play, and the IRS won't let you amend to go back and fix it. And finally, I mentioned earlier 1031. So if you're getting ready to sell your current building because you want to upgrade and go to the next building, you should probably consider a 1031, which would help you avoid the tax on the gain. And when you avoid that tax on the gain, it allows more of your money to go in play to the next property. So that would help you there very nicely. Go ahead and take advantage of that. And you can, on the increase of basis in the second building, the building that you're buying, you would be able to take advantage of the cost seg tax benefits there. The reason that you want to do these, or most people want to do them, is it reduces your outflow of money that was otherwise going down to DC. The permanent savings can come into play here because you're pulling it out at ordinary tax rates, and it's coming back in under the cap gain rates. And then it allows for future write-offs. So if you've got a building that's got an old roof or an old HVAC system, those are items, as I mentioned earlier, that you cannot accelerate. And so with that said, our report, a properly completed cost seg report, will have those items broken out for you. And so when you have those items broken out in 10 years, when you go to replace the roof and put a new roof on the building, you're going to be able to not only take a deduction and put the new roof on the building, you're going to get to write off the old one as abandoned property. So you get to take a loss as if it was snow plowing on that old roof because you haven't yet fully depreciated it. And a properly completed cost segregation study will have that information for you there. There's no amended return needed. I mentioned that, and we provide those. That's part of our package. You get a tax impact all in 1 year, so that if you have owned the building for 5 or 7 or 10 or 12 years, now you're going to get 5 or 7 or 10 or 12 years worth of depreciation all in the current year. So that's a great tool for you. And you can step back and grab that bonus depreciation even if you've missed it. So we've got some resource guides that typically more of the CPA world get excited about, as opposed to the veterinary practice world. You're probably not going to be concerned about that particular item, but there's some good information there about the various levels of the tax code that have changed over since 1996. And then there may be some questions. I didn't want to go too fast. I didn't want to go too slow. If anybody, as a service to the Granite Peak clientele, what we try to do, or what we do, is offer a complimentary estimate of tax benefit so that you'll know upfront what you stand to save on taxes and what it would cost you to get. Typically, what we find is that if you spend $1 on the study, most people look at it and say, hey, if I spend $1 and save myself $4 or $5 in tax, I'm going to be happy with that. And that's a good scenario. So you give me $1, I save you 4 or 5. Most people say, hey, let's go. We hit that threshold, that first hurdle, at about 300 grand. So if you've spent anything more to buy your building, to build your building, or to renovate your practice, if you've spent more than 300 grand, it's probably going to make sense to do the cost seg, and it will give you better than 4 or 5 to 1. We just need a few items of information, and probably the folks at Granite Peak would be able to help you gather that. And we've got the quick questionnaire that they have, and they would probably send out to you. Are there any questions from the audience? And if I'm not seeing the chat box, so I'm not sure if there.
I don't see any questions in the chat, but Jeff, if someone's planning on doing a renovation to their building, when is the best time for them to contact MS Consultants?
Probably the best time would be to consider looking at, we want to give the baseline. So we want to give you the dollar values of the property as it sat the day you closed on the property. In other words, we're going to step back. You've owned it for, let's say, 5 years, and you've decided, okay, hey, we're going to do some renovations now. So you're going to do some renovations. What's going on? Well, we'll put values on everything in the property, including the roof and the windows and the HVAC, all those items that are not accelerating. And so we've got the baseline study done there. And then when you do your renovation, we would simply have to do a mini cost seg, like miniature, MINI, mini cost seg. And so what that would enable you to do is be able to have the acceleration on the original property up to whatever date. And then when you do the renovation, you get the accelerated out of the renovation costs, plus anything from the original purchase, the baseline, like the roof or the windows or the doors, which are often, and bathrooms are often the things that are going in a dumpster. You want to upgrade the look from the 1950s look to at least current date. So a bunch of stuff is going in the dumpster. Now you can use our report, the baseline, to say, oh, wait, those original windows they bought were worth $47,000. And the doors, $62,000. And the HVAC, so you get to take abandonment loss on the items that are not in existence anymore. They went in a dumpster, now bam, you get to take a write-off. So that's typically when we would suggest you go ahead and consider plugging it in for the best tax efficient play.
Awesome. And Jeff, I don't know if you see it in the chat, but we
I
do
saw
have one
something pop
question.
up.
Yeah.
I saw something pop up, but then it went away. Oh, there it is. Okay. Owned our property and practice for 7 years. We're looking into reno in the next year. If we overpaid taxes in the last 7 years, is that recouped? Great question. So it's not that you, well, I get you. One way of looking at it is to say, yes, you overpaid, but you're going to get to grab what you have done is you've just taken straight line depreciation. Now we're going to go ahead and fix it with the 3115, the change in accounting method, which is not amending. So that's good. And instead of going backward and saying, hey, we're going to amend the past 7 years, which you really can't do anyway, but instead of saying that, you're going to say, hey, listen, we missed 7 years of depreciation. Now we're going to grab that depreciation right now. You get to take it against the tax year, in this case, 23 or possibly 24, depending on if you filed an extension or not. So you could use it for offsetting tax currently based on the prior 7 years of missed depreciation. So you're going to catch that up. They call it a catch up in depreciation. And then when you do the renovation, you're going to get to grab the acceleration off of that in the current year, whether you do the renovation in, I don't think you gave a time frame for that. So if it was in 24 or 25, you would get to claim that whenever the renovation goes in service. So you haven't lost anything. You just haven't taken it yet. So now you can take it. Hopefully that answered your question. And oh, it looks like there's a couple more questions. Oh, look at that. We didn't accelerate depreciation. I see. Oh, thank you. Okay. Oh, that's all from the same person. So you're completely eligible to, and you haven't lost anything. It's just you've waited a little bit to take it, but now you can take it. Any other questions come to mind? I know, Matt, you and I have talked questions over time, and many of your clients have had some, so maybe.
Yeah, and I think you did a pretty good job, answering a lot of the most basic questions. So like, you know, how much does it cost? You mentioned that. Um, you know, what is, what is one of the biggest, you know, misconceptions people have about these cost segregation studies? Is it the fact that they think that their project's too small for it, or, what do you see as people not really, you know, fully understanding?
Bear with me. So sometimes I get pushback and people say, well, somebody told me if I take all my depreciation early, I'm not going to have any depreciation later, which is true. If you take all of your depreciation early, you won't have any depreciation later, but we're not talking about taking all of it. If you look here, I stepped back to these examples. We're only accelerating 23%, which means you'll still have 77% of the depreciation available. So you'll still have over 3/4 of it on a go forward basis. But because it's so powerful to take it early versus later, it does still give you this huge tax impact today. So the misconception is people think, well, I wouldn't want to, in a few years after doing this, not have any depreciation. You're still going to have 77% of it. So that's not an issue. And, some people are concerned about that. Some people are concerned that they, what if they don't need it? What you can do, and Granite Peak would help their clients figure out, is do you need to claim bonus depreciation on all of this? Because automatically there's a thing called loss carry forward. So if we create this loss and you don't need it all right off the bat, in other words, you can't use it all up in the first year, it will automatically flow over to subsequent years until you end up using it up. So it's like you walk into that next tax year with deductions in your back pocket and you get to use them then. And there's two schools of thought there. One is just call it all bonus and do it all right now. Or you just say, you know what, we're not going to need this all right now. So we'll take bonus on the 15-year only, and we won't take bonus on the 5 and the 7. Or we'll take bonus on the 5-year and the 15 and not the 7. So there's a lot of tax planning that your accountants will help you with there.
Fantastic. Does anyone else have any other questions for Jeff? Um, so I'll put it in the group chat again, but as a reminder, if you would like to receive the proper CE credits for today's seminar with Jeff, please email your full name to the email that's listed in the chat. Jeff, on behalf of the team, would like to really thank you and MS Consultants for all that you've done for us and all of our clients. And, it's always great to hear from you, and I'm sure everyone here also appreciates it.
Well, thanks again for having me out. And it's great to do these virtual or live, and appreciate being included. And if anyone has any questions, obviously reach out to you guys, and then through you that you can reach out to me anytime. So thanks for your time.